Greetings. This is Tim Fry with McGuire Woods, and we're so thankful and appreciative of you all joining us today. Hopefully you have warmer weather than we do in Chicago, but my colleague Amanda Reynes and I are privileged to be joined today by our friends from RSM. And in thinking through this webinar as part of this series, we thought about kind of healthcare regulatory considerations during COVID-19, and we're going to be covering a number of them. But COVID-19 impacted financials, and we can't think of a better group of people than our friends Patrick and Matt for RSM, who focuses on middle market audit, tax, and consulting services, and have a great wealth of experience in the healthcare private equity space, especially that's where we've gotten to know them, but in other areas as well, and going to give us a great insight to start today's conversation. And I'll turn it over to them in just a second in terms of what they're seeing on the financials, how that's impacting kind of the financial diligence. And then we'll kind of close by some of the legal diligence items and some of the things as potentially buyers, what you should be asking before you even get the lawyers involved, and think through your deals and how COVID-19 has changed. Just one word a minute before we kick off in terms of this series that McGuire Woods has been putting on. My colleague Amanda Reynes and I are part of the healthcare group at McGuire Woods. Both do a lot in the deal space. Amanda, more of a healthcare transactional attorney, and myself as a healthcare regulatory attorney. And during 2020, that was a lot of provider relief fund and COVID-19 related issues leading to today's session. So with that, let's not spend much more time listening to a lawyer give preamble, and I'll turn it to Patrick and Matt to talk a little bit about what they're seeing and the financial side of these deals. Thank you, guys.
Thanks, Tim. Good afternoon, everybody. My name is Matt Wolf. I am a Director and Healthcare Senior Analyst with RSM, which, as Tim mentioned, is the leading provider of advisory and accounting services to middle market firms globally. Patrick and I help lead our healthcare team, and within that team, we see well over about 100 deals in the kind of broad healthcare space per year at least. And my role is I support kind of the valuation side of that. And then as an analyst, I spend a lot of time studying what's going on in the economy, what's going on in the ecosystem, and what does that mean for our clients as we work to help them be successful by whatever measure that is. And we thought that it would make sense to start off today's conversation with just an overview of the deal environment going forward. Certainly we saw a slew of deals fourth quarter of last year. We expect that will continue. We want to talk about some of those drivers so that as we're dealing with the financial regulatory issues, whether they're kind of holdovers around provider relief funding or new, we have that kind of deal environment context. And whenever I talk about the deal environment looking forward, I love this quote. It is no coincidence that before the Great Depression, we were using horses and carts, and afterward, we were a car-based society. And this is what is happening now with AI and digital technologies. And certainly healthcare is not immune to that. It's, I would argue, almost at the forefront of that transformation. These trends, we've seen it across all industries in the economy, trends that were lying under kind of the water being pulled forward and really driving deal activity as investors or strategics kind of reevaluate their position within those industries and how they're investing or divesting. And, in terms of healthcare, this is kind of our view. It will accelerate deal flow. And what does that transformation look like? For years, we've been talking about kind of this idea of the Netflix for healthcare. Patients want their healthcare to be on demand, customized to them, convenient, available when and where they are, just the same way they access everything else, from shopping to their banking, buying a home, applying for jobs. It's all customized and on demand, or it can be if they so choose it, except for healthcare. And what the pandemic has done is accelerate that at least 5 to 10 years, right? We've now had tens of millions of people, and perhaps more importantly, thousands of physicians who have experienced some sort of telehealth or other digital health platform and realized that it can work, at least in some cases, and it's an option. And that's not going away. The genie's out of the bottle. And this will force investors, strategics, other corporates to evaluate their positioning within the ecosystem, and will lead to a lot of investment and divestment activity. You know, we also saw COVID-19, the response to the pandemic, accelerate exits by independent physician owners. Either they realize they'll need technology in the future that they can't have, or they're just kind of scared by living through the lean times of the spring and summer, the financially lean times. And you know, now they're starting to answer when they get that call or email from either a private equity investor or a strategic partner, right? They're evaluating that more fully. And certainly the favorable financing environment will continue for several years. We expect that to continue based on everything that the Fed and other central banks have said around the world. So again, you know, robust outlook from our perspective. Some risks to that deal flow would be particularly as buyers, whether they're financial buyers or strategic buyers, focus on optimizing all of the companies that they bought, or if you know, financial private equity buyers seek to rebalance their portfolios maybe away from healthcare, looking at other sectors after sort of going on a buying spree. And the other risk to that deal flow, and we'll talk a little bit more about that later, would be labor constraints. We've seen a lot of healthcare workers exit the workforce, and so depending on where you're investing, where you're operating, certainly in some of the physical healthcare services, labor constraints might be a real headwind to that thesis or that strategy, and that might, in some sectors, constrain deal flow. This is all happening obviously within the context of the overall economy. I'm not going to go over all of this information. There's a lot here. If you want any of this data or any of these charts, please reach out. Happy to provide them. You know, we're forecasting a robust economic GDP growth this year for all the reasons stated here. Certainly as the economy reopens, and GDP is important, right? The rising tide lifts all boats. More robust GDP growth generally results in more robust deal activity. These are all good things. Let's get that. Unemployment, we already talked about that a little bit, but I want to mention specifically that we'll continue to see the unemployment rate fall. We had jobless claims come out earlier this morning. It was maybe a little bit better than expected. Still, you know, almost 1 million new jobless claims a week, which is an absurd number. But that unemployment rate is coming down. We think it will continue to come down. The real number to watch there, of course, is the labor force participation rate. What is the size of the labor force? Are people who were either unemployed during the pandemic or just chose to leave the workforce to take care of kids' virtual schooling or sick family or friends, are they coming back in the workforce? Is that labor available? Inflation, not really a concern. There's too much slack in the economy, even with all of the stimulus and fiscal aid, for there to be real short or even medium-term inflation risks. I also want to highlight the RSM Middle Market Business Index survey. This is something that we normally do quarterly, but since the pandemic started, we've been doing monthly with Harris Poll and Moody's, and we survey about 700 middle market executives across the country just for their optimism. We asked a bunch of other questions, but this is the top line level and shows that they're still generally optimistic about the prospects. It is decreasing. That is a statistically significant decline in December, but we're still generally more optimistic than we were during the depths of the pandemic, which obviously also is good for the deal environment generally. The other aspect that we point to when we look at the outlook for the deal environment is just the incredible amount of dry powder. If we look at just buyout funds focused on healthcare or investing in healthcare, is $165 billion of dry powder. If we look at private equity, total worldwide, $1.5 trillion. And it's important to look at the other broader number too, because as we saw with the advent or the expansion of telehealth with the result of the pandemic, we've seen health technology, which is kind of difficult to categorize, also see an incredible amount of interest. So there's interest, there's demand for these companies, and there's plenty of money to back up those investments. I mentioned the labor before. This chart just kind of shows no matter how you slice it or look at healthcare, we're still just not back to that pre-COVID employment levels. And so to some degree, depending on where you're operating, that may have some challenges, may constrain some growth, or make execution a little difficult, at least in the short term. We'll see how that shakes out over the long term. So, that was a very brief overview of the deal environment. So, we're talking about how do you get a deal done during COVID, but what is that going to look like going forward too? What are some of those considerations and things to think about 2021 and even into 2022? Because we don't expect to see really a slowdown in deals overall. So we're going to transition from that kind of outlook now to what do you think about? How do you approach these things? And I'll cover some of the valuation considerations. That's more my technical area. And when it comes to valuation, we look at the past, which, now we have, unfortunately, almost a year of COVID data. We look at the past to the extent that it informs us about the future, right? Valuation is all about the future cash flows, revenue, margin growth, exit opportunities. So we look at the past to the extent it informs us about the future. And the past, that there's a lot of uncertainty there, right? That typical linkage has been broken. And there's all these other questions kind of hanging out there in the future. When are we going to get back to full capacity? Many providers are, not all. What will there be future rounds of provider relief funding? HHS keeps changing the rules and the reporting requirements on it. What does that mean? Telehealth waivers, if you're investing and looking at that space, what is the future of that regulatory and reimbursement environment? Sequestration, longer-term Medicaid expansion, the shift to value-based care. How do we think about that in the future? It's difficult. It's more uncertain than it perhaps ever has been, at least since the advent of the ACA. This has resulted from a valuation perspective in, complex consideration. So we're seeing a lot more sort of contingent consideration based on hitting not even just EBITDA targets, but volume targets, right? Just speaking back to that kind of capacity and keeping providers on staff and engaged. It's even maybe less about the EBITDA and just about the actual volumes themselves. In some cases, protracted deal timelines, although I worked on a couple deals over, late November, December, one of which, beginning of conversation to the close was 30 days, right? So again, a lot of it is all over the place. It's uncertainty, and one way to deal with that is it just can take more time to get the deal done. Noise in the multiples, certainly, especially you look at other transactions, it's never really been a one-to-one, but in today's environment, even if you're doing a dermatology acquisition and of a half dozen other dermatology deals that have happened, you have some information on those multiples, but the drivers behind those transactions can be so different and so disparate than they really have been before, that it takes an extra level of due diligence. And if you have to value your positions and report it to your investors or LPs, there's a lot of pitfalls with calibrating that market data and making sure that you're kind of representing an appropriate fair value of that those investment positions to your stakeholders. So broader dispersion, lots of uncertainty. We're trying to divine the future in many ways, and the past is not a great indicator of that. And we'll talk more about ways kind of around that, but there's still just a lot of uncertainty that has yet to shake out. The other question I get asked all the time is about multiples. What are you seeing with multiples? And again, the answer is dispersion. The highs are getting higher, the lows are getting lower, but in general, I like to think about multiples as a price like any other. right? It is influenced by supply and demand. And as I showed before with the dry powder and some of the fundamental trends happening in the industry, in terms of the digitization of healthcare, the demand for companies or making investments in this space has arguably never been higher. And especially on the provider side, the physical provider side of healthcare, the supply of those companies is not increasing as quickly. So we're seeing multiples hold relatively stable or even increase in some pockets, and in others decrease, right? I mean, this is a useful framework, but if you think back to Econ 101, you have to make all these assumptions about a perfect competitive environment for this to absolutely hold true. And obviously we don't operate in a perfect competitive environment. And so you have some outliers where, going back to what we were talking about earlier with, independent providers or, owner physicians kind of realizing, you know what, it's time to hang up the stethoscope. I need a partner. I need to step away from this business. And so we've seen a lot more deals at very low multiples, right? Even sizable companies, that are profitable, 2 to 3 times EBITDA. I mean, how do you get your head around that? How do you evaluate that and think about that going forward? So the answer to the multiples question is that it's, generally flat, but at a high level. The highs are getting higher, the lows are getting lower, but when you dig down into some of these specialties, it's a different story, right? It's almost a unique story in itself. Healthcare technology, those multiples are getting to be pretty incredible already, and I think they have a ways to go before we hit the top there. Behavioral health, still lots of deals being done, but we see lots of low multiples there. So you got to dig down below the headline to get the real story about those multiples. But as you're trying to evaluate that, at least at a headline level, it's greater dispersion, higher highs, lower lows, a wider range of these multiples, because there are so many different factors influencing this, whether they're on the demand side or the supply side, but then also just this uncertainty. What does the future look like? How do we think about the past? And each deal is different. Each segment is different. There's a lot of considerations that go into the valuation in these multiples that they just didn't have to think about a couple years ago. And that's, so how do you think about that? How do you make sense of this? Well, you need to kind of do your homework and really get in and understand aspects of the business that maybe you didn't have to look at quite in the same way before. And that's where, good kind of financial due diligence can come in. And that is what my colleague Patrick is going to talk about next. Patrick?
Yeah, thanks, Matt. And it's a great segue into this next topic here. Just a quick introduction on myself. I'm a director in our transaction advisory services at RSM, and I lead our healthcare sell-side diligence efforts. So primarily working with the seller and helping them get ready for their exit. So I think to start here, I'll just provide a quick recap on what we saw. COVID, we were expecting another robust year from the M&A market and transactions. What we saw kind of during the end of Q1, Q2 is a lot of transactions went on hold, kind of fell off a cliff. And the limited transactions we saw were primarily smaller add-ons, kind of opportunistic add-ons where maybe it was a small mom and pop founder-owned business that didn't have a strong balance sheet and, for lack of better words, needed bailed out by maybe, a financial sponsor or someone else that could weather the storm. The interesting thing is, there was no playbook for COVID, so people just kind of hung tight for a while and tried to figure out what was happening with the assets that they had, managing, trying to get a PPP loan, all those types of things. So I think what we have seen, and this is as the activity started to pick back up and the uncertainty, the degree of uncertainty became a little bit less. We saw what we've been seeing is more earnouts, both on top line and EBITDA, again, to help mitigate the uncertainty. I'd say pre-COVID earnouts were, becoming more and more rare due to the competitive environment, but the buyer wants to protect themselves, and rightfully so. Also, all these kind of nuances with COVID, balance sheets were wacky. People were delaying payables or having a tough time. Maybe, their billing folks were working from home, so their receivables were growing. Some cash flow problems, and there's some working capital things to think about as well. We'll get into that a little bit later. And then also too, the PPP loans, right? All this stuff. At the end of the day, our work needs to make it into the purchase agreement, and so that's where it's important that the folks like McGuire Woods and the transaction teams at RSM work together, and we make sure that all that gets built into the purchase agreement in a concise manner with exhibits and those types of things. So I'll go ahead and move on to these next couple slides here, and what these next few slides here are really just some examples of what we saw happen. Again, these are very simple examples and primarily focused on the top line, and I'll kind of share some buyer and seller perspectives here. So I'll just use an example. This company, right, they saw a little bit of a drop from kind of March into May, primarily due to COVID. They probably lost some volume. This could be maybe a primary care provider who maybe had to cancel some or advise the patient, hey, unless this is more emergent, or maybe checkups, I'm going to defer a little bit for a while. I need to get some sanitation protocols in order. So, they lost some volume for a solid 3 months. And, what they needed to do is provide some solutions, some innovative solutions. So sophisticated sellers or strong management teams, maybe they were smart enough to call folks like us at RSM and get a telehealth solution set up and navigate that quickly. And they were able to recover their volume pretty quickly. Now, this is a great story for a seller, right? They can say, hey, look, there's just a little bit of a hole here to fill. And as you can see, we're back up to normal. Generally, a buyer's going to accept the normalizing adjustment there, right? They're going to say, hey, the management team was innovative. They were strong, and they came up with a solution, and they were able to rebound pretty quickly. It's a great story. And, the seller's going to be able to extract some value from that. The next example here, this is where this would be maybe like an orthopedic surgeon group or where they have maybe a high degree of elective procedures, a hip replacement, which, oftentimes isn't an emergent matter. A lot of procedures got delayed. And so in this case, there's a drop off of, maybe 3-4 months, and then you'll see, there's this big kind of pop a few months later where they recovered that loss. Interestingly enough, sometimes we do work on this to normalize it, and there's some cost components to think about, maybe overtime and provider availability and how that works. But over the course of a period, the net adjustment might be marginal. However, on a monthly basis, right, you may see some lumpiness there, and to try to normalize that. But I think, again, in this scenario, some key things the seller's going to want to do here is show that they were able to manage their backlog of patients, not lose patients to other competitors, and they're able to, meet the adversity, right? They were able to increase capacity, right, and with a short-term notice. We'll go on to the next one here. This is one where, maybe the company hasn't recovered fully yet. So, this might be somewhat of maybe a home health business or something where volumes drop. Patients are a little hesitant to let people in their home, and they're still struggling. While they're not, the volumes aren't at necessarily the trough. However, they're not pre-COVID levels. And so doing a normalizing adjustment here, while certainly makes sense to do, you're going to get a lot more buyer scrutiny here, right? They're going to say, well, when are things going to get back to normal? What's your plan? Have you thought about other service offerings? And, that's going to be something the seller is really going to need to sharpen their pencil on. Maybe it's additional macro research or analysis to give the buyer some comfort on the exact time. Maybe it's month and year of when things are going to get back to normal. So, unfortunately, this one is a tough sell here to adjust, and certainly to try to adjust to the, call it pre-COVID levels. Now, another scenario which is interesting, and we've seen this as well, is actually some businesses have been positively affected, and I'll just use an urgent care as an example here, where maybe they did see a little bit of a drop off. I think generally speaking, nearly all specialties or providers saw some sort of decline for generally in that kind of Q2 time frame. This might be maybe an urgent care business where they're doing a lot of COVID tests, right? And their volume's just been surging. Obviously, we're still seeing a lot of high testing volume, and so they actually have some upside here. So, potentially, right? There's a few views that, well, hey, maybe there's an upside adjustment for those months where things were a little bit low when they saw volumes drop, but there also could potentially be a downside adjustment for sustainability of the growth or these peaks here. And I think what's important, what a seller will want to do is, they're going to want to say they're going to need to make a strong argument that, well, hey, COVID tests are here to stay. We're probably still going to be dealing with this well into 2021, and who knows how effective these vaccines are going to be. Hey, maybe vaccines are going to replace some of this volume. And, potentially these vaccines provide a new revenue stream that would help that. And so, but they're also going to want to provide the buyer, with a strong sense of security and assurance that this stuff is here to stay. So, assuming that a seller can do that and is sophisticated, hopefully a buyer will accept it, but also, a buyer will maybe discount some of that upside, right? So, it's really important that, that the management teams, from the seller, are understanding, both the trends at their business, what their competitors are doing, and what's happening maybe more at a macro level. Also to, hey, what's short-term, medium, and long-term impact, to the extent that, they can provide some meaningful data. Another thing that's an important thing to look at from a diligence perspective is just operating expenses. Certain expenses may be either put on hold or just down for either cash flow management or a variety of things. I think, advertising and marketing might be one, right? Where, it's kind of a discretionary expense that, it can pull a lever and turn it on or off. Sometimes that's hard to, quantify the impact of the efforts. But certainly if you see that declining, that could have some potential future downside. Also, travel and entertainment, that could be a big piece of the business normally. And now COVID, that's kind of dropped off significantly, right? Also, a lot of companies maybe didn't pay bonuses, uncertainty. Maybe they usually got paid out in, Q1, Q2 for the previous year, or quarterly bonuses, and well, hey, we're going to hold off this year. And instead of doing that, and they didn't have to lay folks off. And so, in addition to the top line analysis, some of this stuff on the operating expenses is very important to understand, and again, can cause some adjustments, some what we call downward adjustments. You need to run rate the expenses and understand that. Also, one-time items such as, supplies, personal protective wear, masks, gowns, right, temporary structures. For the most part, that's probably marginal, but, maybe you had to hire a cleaning crew, every day, or additional FTEs to increase sanitation protocols. And, the question is, how long is that going to last? Is it here to stay? And this slide here, I mean, it really and just to kind of summarize is what I just talked about is, you have to have a narrative with your story. Track the support if you want credit for an add back, whether it's these one-time expenses, either you're tracking, productivity measures. And that's best to do real time. It's a little bit harder to kind of go back several months later and kind of get your arms around that, to the extent that people are aware of this and able to maintain spreadsheets and items is very key. And then, it has to be balanced, right? You can't just take the upside, right? If you take the revenue side, for example, on a run rate, you got to think about other variable costs that need to be burdened. And then also, this kind of what we call bridge the results to the budgets. How far off did you miss budget, and are you going to be able to achieve budgets this year? What does that look like? And I know the McGuire team is going to touch on some of this, but similar to the quality of earnings, net working capital can also need a little more scrutiny, right? I think I made a few points about, when's the transaction going to close? Are we still going to be in a pandemic? Are receivables, normalized? Are they deflated? What's the valuation based on, and can you align the working capital to that? So again, you got to be a little creative, and you have to understand, what you're trying to present. And then same thing on the indebtedness side, right? There's some extra hoops to jump through to think about, PPP loans, maybe deferral of payroll taxes. A buyer certainly isn't going to want to take on any liabilities that they didn't, receive any favorable credit for on their watch. And then, a lot of times some of these payables can be treated as debt, like if someone decided to string out their payables for, 90, 120 days, kind of beyond normal. And then a few other interesting items, PTO balances, maybe people weren't taking time off or working from home and able to accrue quite a large number that are balanced. It's kind of above and beyond normal. So with that, I'm going to pass it over to the McGuire Woods team.
Hey, Patrick, Matt, thank you both so much. Really appreciate it. So helpful. And something I failed to say in my introduction, there should be a Q&A box somewhere in your system. Feel free to put some questions in, either for Amanda and I as we go through, or Patrick and Matt as well. And I'm sure we'll either address some of them through the chat feature or at the end. So for kind of the next 15, 20 minutes to close out, we're going to shift into the kind of the legal diligence things. Many of them will kind of follow on what our RSM colleagues have already shared. What I would note is we're going to try not to get too lawyerly into the weeds of everything we're going to look at or everything that COVID did, but instead big buckets. So if you're on buy side, things that, as a buyer, you can already kind of queue up in the conversation. Just know that it's going to be something that is important. Your Q of E may look at it. Your lawyers are going to look at it. Why not start that conversation now? And as a seller, know that this is areas that the lawyers are going to be worried about. And we'll try not to be too lawyerly, and Amanda and I will go a bit back and forth. So Amanda will kick us off on some of these, talking through some of the employment-related considerations on the legal side.
Yeah, thanks, Tim. And speaking of kind of one of those key buckets, our team throughout this COVID era has really continued to kind of flush out these key issue areas as it relates to the legal diligence review and the impacts that COVID-19 has had on these key issue areas, how thoughtful companies have been as they've returned and continued to adjust their operations as a result of the pandemic, employment-related considerations, obviously being one of those large buckets, just given how key a company's employees are to success, not only for a transaction, but then the go-forward integration as well. So this is one of those areas that can become extremely critical. And one sub-area to kind of explore within this larger bucket is, as a result of COVID, kind of how many employees have been furloughed, and have they all returned? It was Matt, I believe, who had mentioned kind of some labor restraints and, employees not necessarily returning, had worked on a deal recently with a smaller practice where a handful of their key employees had decided not to return back to work due to personal reasons. So this is obviously then a key discussion to have with regard to kind of the overall valuation of that company, as well as go forward integration, as the buyer needs to then figure out a plan for hiring, covering shifts, ensuring continuity. Along those same lines, in the earlier months of COVID, we were seeing a lot of pay reductions in physician draws. So understanding if those existed or they're still ongoing, how the company handled those, how they were documented, how the employees, providers kind of acknowledged and agreed to the pay reductions, and whether the employees have since been either trued up or brought back to their pre-COVID levels. All of these are areas and questions that could potentially play into the overall transaction structure. Perhaps you're looking for indemnity for matters related to furloughs or any issues there, or employee claims related to unsafe working conditions. Things just to keep on the radar as you kind of look through these employment-related considerations. I think one thing that's also going to be becoming even more pertinent with these various vaccine rollouts is how the employer has been handling this. So under federal law, the EEOC, while not carte blanche, has said employers can require employees to receive the COVID vaccine as long as certain requirements and exceptions are met. And speaking with some of our labor and employment colleagues, we haven't really been seeing this kind of mandate across the board, just given the host of L&E issues that can arise regarding that, coupled with the fact that, we are seeing state proposals aimed at kind of prohibiting an employer from taking any adverse employment actions against individuals who exercise their right not to get vaccinated. So while these are obviously ongoing and developing areas, definitely is something that we'll want to inquire and understand how the employer has been handling this to ascertain kind of what, if any, risk exists there. I think that leads us to some government funding considerations as well.
Yeah, and one thing that I'll say both about the government funding, and Amanda touched on this already, but employment especially, is, look, this isn't your lawyer's job, but we're seeing it in a lot of deals. There are thoughtful targets out there and those that have been less thoughtful. And there are certainly operations in deals where we can sort of tell and we end up spending time on it, and maybe the Q of E, you make an adjustment, or the purchase price gets adjusted, or you do a holdback of some sort, which we'll talk about when we get to structuring a little bit more. But ultimately, there's a lot of anger among the staff and the physicians over how things were handled in the last 10 months to a year. And then there are other companies where people have been transparent and maybe worked well with the state's unemployment insurance office and helped their staff. So those are things that if you're on the buy side, before we even get to legal diligence, how are people feeling about things? And I bring that up here on the government funding slide, because that's also the case with the government funding programs. Look, we can ask all these questions. Have they used any of the programs? Do we have to make adjustments for some of the slides that Patrick was showing in terms of where are the bar charts? What kind of Q of E adjustment needs to be done? What kind of normalization? How are we going to address that coming up for net working capital? But ultimately, the thing that terrifies us is your legal counsel on a buy side is going to be, did they get automatic funding from the HHS Provider Relief Funding Program in April? And what did they do with it? Did they think about it? Or did they got money in their bank account and never really thought about it because it must be their money, the government sent it to them. And the Provider Relief Fund program has really, if you haven't been following it closely, we've probably done 15 to 20 alerts on it over the course of the year because it's been an airplane that HHS has built in the air. And there are all kinds of obligations on these individuals, even if they never asked for the money, let alone if they asked for the money. Did they receive accelerated and advance payments, and did they properly fill out the forms, and what's their plan on a go-forward basis? I think most obvious has been the Paycheck Protection Program, and I think probably everyone on this call is familiar with the national restaurant chains that were eligible, received money, and then got negative news stories written about them. The LA Lakers received Paycheck Protection Program money, as I recall. And it just comes to mind. That's all you can think about with the PPP program is all the kind of negative publicity that got hit. But some of these other programs may have it too. And they have all kinds of government requirements. And depending on who your target is, have they been thoughtful? Have they taken advantage of these programs in the spirit that they were intended? Have they followed the terms and conditions? Have they submitted appropriate paperwork? Or is this going to be a headache that you're going to be dealing with over the next few years after a transaction? Because, look, it was a crisis. Everybody took the resources they could, but now we're a year from the crisis situation, or 10 months from the initial crisis. And yes, people still have very difficult financial situations, but have they put that time in? Have they worked with counsel? Do they have the documents backing it up? And quite honestly, before you even have an Amanda or I look at those documents, you should be able to get a sense of it, or you could get a sense of it as a buyer by having those conversations. Tell us about the government funding you got during COVID. How have you thought about it? What were the steps you took? Did you give any back and think it through? How did you think about the tax deferral options and whatnot? All questions that you may want to be asking on buy side before you even get to your lawyers involved, because they'll get a sense on what's going on.
Yeah, and I think that lends well to kind of considering some vendor considerations that go into kind of the diligence process as well. Kind of two key things, one of them being force majeure notices, which we have seen be utilized over the last 10 months. So understanding in these lists of material contracts that you're getting from seller, do those exist such that if they need to be utilized, they could be utilized, but also have they been utilized at all? You don't want to kind of come across a situation where you have one of the key vendors or suppliers who has acted on one of those provisions come in, and then, you're getting a contract that you didn't expect was not going to be operable for a while. In addition, I think in the earlier months and still today, we're seeing some rent deferrals, for example. And so if a company was deferring rent payments, understanding kind of how that was handled and where they are since those deferrals of rent have taken place. Have they been paid back such that the landlord has been made full? The buyer isn't going to want to step into that situation where then as a successor tenant, the landlord is looking for those payments in the future. And in terms of, we'll talk about this a little bit as well in terms of structuring, but just knowing up front as a seller and in terms of how we've generally seen these types of deferrals handled is that they are being treated kind of as debt-like items as part of the transaction. So making sure that you know about what, if any, deferrals exist out there so that they can be properly structured and handled as you move toward the closing.
And let's just say, practically speaking, and we're going to get to other practical things of the business here on this next slide, but rent deferrals, you may have really, if you're on sell side, if you're a seller listening on this call, you may have really ticked off your landlord. Look, maybe they allowed you to do it because they knew that you didn't have a choice. But now you're in a deal, or you're about to have a deal, and you have to go to them for a favor, a consent, a waiver of notice, whatnot. They're not in a very forgiving mood necessarily right now. They have their own mortgage issues. So think that through. Those types of things, landlords are often huge lead time issues. Other vendors, especially in spaces like ophthalmology, where there's so much retina injections, those can be long lead time issues. Any type of significant equipment lease programs, just in terms of doing a deal, those could be the reasons we don't close a deal. And so thinking that through, how did the relationship make it through? And similarly, that's this slide. How did your business come through? Not now as lawyers, the same way Matt and Patrick are worried in terms of where did that come in terms of did you replace the business? But did you kind of hack together a telehealth platform? As a buyer, non-counsel, you can have some wonderful conversations with your potential partners or sellers about all the things they tried to accomplish during COVID and how they came up with some amazing solutions on the fly. But those may not be HIPAA compliant, right? If you're using FaceTime, Apple FaceTime. I had a doctor, my own doctor, who wanted to use that to kind of have some conversations because I couldn't see her in the office. Well, that's amazing. And the federal government gave flexibility during COVID to do it. But does the doctors, if you're in the physician space, do they want to continue doing telehealth? Have they found that to be great? I know some doctors, like some lawyers, have found this flexibility amazing. Before you go to the office, you can meet with some of your patients early in the morning after coffee and knock some stuff out. And COVID has allowed them to kind of change their schedule. Do they want to continue doing that? If they do, Apple FaceTime is not going to work going forward. What platforms can we launch instead? Does the commercial payer agreements, are they going to allow that to happen? Or are we in a situation where we're going to kind of have to cut all that off and because it wasn't regulatorily compliant, we have to end that, and therefore that pie chart or bar chart where you see actually some extra income, we're going to lose it all right after the deal. And as your lawyers on a buy-side deal, we're going to say, look, you got to get rid of it. Well, that's part of their go-forward plan. So you can have some of those conversations from the get-go with your potential partners that as lawyers we can't necessarily have, about what creative solutions did you do? How did you bring them about? Who did you work with? Forget the contracts. We'll work on that with you. We'll work with you on whether it's compliant or not. But what is their go-forward plan such that we can make sure that as we try to get away from these waivers, do we have to look for future government flexibility in these spaces, or do we have to use it from what you already did? Do we have to change operations? All things that we can have a nice conversation about and really build that into the deal and your go-forward plans.
So just as there's been additional considerations that have come up in the valuation process as part of the financial diligence and the legal diligence process, there's also obviously been additional considerations to take into account when it comes to structuring the transaction. And I think kind of the key theme that we've seen throughout the past 10 months, almost a year now, is really mitigating the risk where the risk can be mitigated. And so what does that look like in terms of structuring the deal, the documents, things like that, in terms of pricing, reps and warranties, indemnities? That's what we're going to spend the remaining time discussing, and we'll welcome questions as well as they arise.
So Patrick used a word that as a healthcare regulatory attorney has always been difficult to hear: earnouts. And if you know you've spoken with your healthcare counsel or with anyone here at McGuire Woods, those types of contingencies have additional regulatory hair on them that they wouldn't if you were in a non-healthcare business. And the government's concern has always been that contingencies, earnouts, etc., would be potentially a disguised way of paying for referrals, paying for ongoing business generation from a provider. And you know, COVID, I think, has shown why contingencies, holdbacks, earnouts can be so critical in transactional corporate speak, which is it helps overcome some of those uncertainties, that risk mitigation, not trying to reward or induce additional business, but trying to get to the right answer around what is the value of the business, what happens when multiple parties disagree. I'll just say this puts a huge tension huge tension in terms of that kind of balance between the goals of your transaction, getting over some of the Q of E concerns, and of course those regulatory considerations. And I just say we are seeing more deals have to consider things like that, but you want to be sensitive, you want to be thoughtful, you want to make sure you don't fall into an area you can't go. The RSM team kind of already talked a little bit about setting prices, but you see that on this slide as well. Hey, can we blend COVID and past? And then in terms of kind of timing of transactions, has this slowed things down? I think it did for a while, not just in terms of deal flow, but just also in terms of renegotiating, thinking through a lot of these issues. At this point, deals are happening at a pretty standard clip from LOI to closing, and I wouldn't say as a lawyer we're seeing much different in terms of length or negotiations.
So we've all talked a bit about the government relief funds, and those, I think I can count on less than one hand the number of deals that I've done over the past year where there wasn't some form of government relief. So how do we structure those? What considerations need to go in there? Those are often handled as debt in terms of the transaction, but additional considerations exist as well. We were talking about the PPP loans, based on the guidance there. In terms of getting the deal done, do we need any consent regarding that PPP loan, depending on how the transaction's structured, as well as kind of whether any escrow needs are there. In terms of reps and warranties, undoubtedly, right, COVID has really just kind of astronomically changed and impacted the way that healthcare businesses operated and continue to operate today. And so it's vital to ensure then that the reps and warranties are also updated to kind of reflect this changing environment that is still ongoing, to ensure that there's coverage there. So what does this look like? Including reps and warranties that touch on compliance with the CARES Act and government programs, terms and conditions of eligibility, compliance with employment matters that we discussed, and any rent deferrals or delayed delivery of capital expenditures. In terms of rep and warranty insurance, it's still absolutely being used, as we're seeing. And I think, in speaking with one of my colleagues who really focuses in this space, anyone considering an RWI policy should still continue to expect kind of that broad COVID-19 carve-out that we've been seeing. With that said, I think in kind of the recent months we have seen a bit more willingness to kind of limit the scope of these policies, which holds especially true if a target has had kind of little to no impact, which we've seen in certain sectors more than others. Urgent care, for example, where they haven't really had to face as much shutdown or elective procedure bans, things like that. But as long as there are these civil orders and government mandates in place with regard to COVID and the operation of businesses, I think we will likely continue to see these exclusions in RWI policies for the near future. And then just touching on escrows and indemnities, so over the past 10 months or so, I think we've seen a bit more appetite to take a bit of an more aggressive stance on things like escrows or caps and baskets, survival periods, just given the unknowns that had existed in light of COVID. So we've seen separate escrows for networking, capital, and government funds, or other diligence matters that we had discussed depending on the nature that arises. And then in indemnification, specific indemnities related to any COVID-19 matters. For example, if we've seen in some circumstances, if a company had kind of acquired additional add-ons, was there compliance with the government funds that were provided there? As the country sort of starts to continue to sink into this new kind of COVID reality in a somewhat steady and hopefully what will be declining state in the near future here, I think we will likely see these concepts revisited as leverage kind of shifts back again.
Thanks, Amanda. And the last slide we had as a firm kind of revisits the end of Patrick's presentation or portion, working capital structures. I'm not going to spend very long on here, but all those things through financial diligence, legal diligence, the net working capital pieces of these deals are getting heavily negotiated, more than they have historically, I'd say, because we have to address all these different things and how much we're going to recognize things like paid time off if that went up and wasn't used because of vacations. So with that, we're approaching the top of the hour. You're going to have access to the slides. I'm putting our contact information on the slide, but I'm going to take the kind of moderator, panelist perspective to jump to a question instead of finishing the slide. And one of those questions, look, we're at a kind of a political moment, and does our RSM colleagues and then McGuire Woods, maybe I'll speak to it unless Amanda wants to jump on it. Hey, political pressure on healthcare deals. What do we see? What's your crystal ball looking like? And Matt, Patrick, maybe I'll let you have a first stab at it, and we'll close this way and then welcome folks to reach out if they have further questions. Matt, Patrick?
Tom. Yeah, happy to. Thanks, Tim. This is Matt Wolf again from RSM. I think so far the Biden administration in terms of healthcare has really, made COVID a focus. We expect that to be certainly past the first 100 days. But, the issue that bubbled up pre-COVID of private equity's involvement in healthcare has not gone away, maybe just backburner. That will return to the front. We saw some pressure on that with the surprise billing law, but we'll see that come back. And also interesting too, and we're watching just like everybody else to see what this means is Kamala Harris and the likely incoming HHS Secretary Javier Becerra both served as attorneys general in California and had their own sort of dealings with consolidation of hospitals and healthcare deals in California, and it will be interesting to see, what, if any, additional or changes to scrutiny come from, that perspective. Definitely something we're watching. Too soon to tell, but an interesting kind of thought exercise.
Matt, thank you so much. And I think the question was probably federal geared. I'll just add, Tim, from McGuire Woods, a couple state items. Won't add anything to your comments at the federal level, but at the state level, something, I wouldn't call it yet a trend, but it's kind of popping up here and there, and that is kind of healthcare deal specific, either additional change of ownership notices or even kind of antitrust light requirements with state transaction notice with an opportunity to review to ensure kind of healthcare competition. And, Washington has added it. Florida has looked at a bill like that, usually tied to past hospital acquisition of physician groups, but the language tends to be broader. And again, I don't think it's a trend yet, but something we could see happening as well if states pick it up, that people should be just kind of paying attention to, keeping their eyes open to see if that changes how transactions move forward in the years to come. So with that, again, want to thank Matt and Patrick and Amanda, and thank you all for joining. Please feel free to reach out to any of us or reach out to us on LinkedIn. We'd welcome the opportunity to dialogue further on any of these topics.